Hello and welcome back to The Note. We're going to tackle a very ambitious topic today. Is stagnation our destiny? Now my guest today spends much of his life thinking about this. He's the global head of the UBS Knowledge Network, Lutfey Siddiqi. Lutfey, thank you very much for joining me today.
Thanks for having me, John.
Now let's start with the topic that nobody can ever avoid. What is the Fed about to do? How important is the Fed's forthcoming decision on interest rates?
I think we don't need to get too game theoretic about the Fed. They are, it's data dependent, and they are as much hostage to data as the rest of us.
Right.
And the data, frankly, have not been mutually consistent throughout the period. Yes, the jobs growth was there, unemployment was down, but until last week, wage pressures weren't there.
Right.
Participation rate was low, arguably still low. Corporate investments remain low. So the data needed to be weighed.
Right.
The second thing is you need to plug it into a model to then get an estimate of how much slack is in there.
Right.
Potential output and output gap is notoriously difficult to measure. Once you've done that, then it's the Fed's reaction function. And there's broadly two possibilities. One is hike early and keep the path shallow. The other is wait a little bit longer, hike late, and
at the moment the data points to the former, hike early and keep it shallow.
That's right. At the moment it looks like the December 16th we'll see the first hike.
Now, let's talk about divergence. As we can see from this chart we'll show you here, people have been expecting divergence, the US to tighten while the Europeans loosen, go in a clearly different direction for a long time. It hasn't happened yet, at least when it comes to target rates. Do you think we will eventually see this delayed divergence occur?
Yes, I think the divergence movie is set to release next
Right.
month. The ECB is expected, the market expects it to cut further negative on the 3rd of December. The economies have been diverging. It was just a question of whether it was diverging enough for the central banks to go in opposite directions. Unemployment in Europe is still 11%.
Right.
US
Double
down
that in the States, right.
to 5%. Output gap in Europe is still probably 2.5%, 3%, whereas it's arguably closer to 1% in the US.
Okay, so obvious horrible things happening still to the European economy. Now that raises the issue of stagnation. If we take a look at what people are expecting for inflation, you can see basically 10 years out, people are expecting something close to a deflationary environment. That sounds almost like secular stagnation to me. Is stagnation our destiny?
Good question, and particularly if you come out of our monetary echo chamber, it's a very pertinent question to ask. I think whether it's stagnation or with some inflation, stagflation, stag is here to stay. That's my personal view. There's all sorts of reasons for that. There's a demographic downdraft, dependency ratios. It could be for the global savings glut. There's a whole lot of explanations for it. But I think that is a real challenge that's here to stay.
Okay, well, that's not exactly cheery. Can I suggest at least one thing might rescue us? We have many improvements in technology. We've been talking about that for a while. That's added into what's now often referred to as the sharing economy, using up slack with Uber, Airbnb, and so on. Can technology, the rise of the robot, save us?
So that's a possibility, whether it's robotics, cloud computing, 3D printing, Internet of Things, potentially a positive thrust to potential output globally. But I think there's potentially three issues to bear in mind. This type of growth could be jobs displacing, inequality widening, and pensions destroying. If I take an example of you and I potentially losing our jobs to a robot, robo-advisors, machine learning, writing.
That not as hypothetical as either of us would like it to be.
Unfortunately not. And, the technology company, probably a startup, 10 people, they IPO, huge valuation. They come into a lot of money, good for them. But the propensity to consume is not high. So they're likely to save that money and get the robo-advisor to put it into passive income-seeking assets that our pensions are seeking as well, potentially driving down the return potential there. So it's a non-trivial issue.
So technology, final question, the technology ultimately drives down our sense of long-term security, our sense of a long-term link with companies, and also drives down that sense of growth in the economy.
But stagnation is not destiny, because things can be done and they are being done. So first of all, think beyond monetary. We need infrastructure spending, structural reforms, public-private partnership. Skills retraining, huge focus needs to be put on education and building our retrainability so that we can get more jobs when that unfortunate event occurs. And then thirdly, we need to create new investable assets, particularly in emerging markets, widen the net of financial inclusions, deepen local capital markets so that the savings glut can find more assets to go into.
Lutfey, thank you very much indeed. I think we've covered more or less the entire waterfront in 5 minutes. I completely agree with that conclusion. Somehow or other, we need to find a big new array of investable assets for pension funds to invest in. That way we avoid the bubbles in the assets we're investing in already, and we begin to rebuild a sense of security for all of us.